You're listening to Fund Shack. I'm Ross Butler, and today my guest is William Benjamin, Head of Alternative Solutions at HSBC Asset Management. William's held several senior roles at HSBC, including Head of Hedge Funds, Head of Alternative Investments, CIO and CEO of Alternatives. He's also been Global Head of Research, and he's done a stint at Goldman Sachs as an Executive Director. William, welcome to Fund Shack. You've been in the alternative space for quite some time, and it's been a great place. It's been a great place to be. And while the last couple of years has maybe been a little bit more strained in terms of M&A and so on, I don't know about you, but I kind of feel that we're reaching a really good moment. I feel like it's all coming together, and alternatives feel a little less alternatives and a little bit more like kind of a mainstream default option for portfolios for all types of investors. I don't know, maybe I'm just feeling optimistic this week, but it feels like maybe the industry is about to hit the mother lode. How are you seeing things from the HSBC asset management perspective?
Yeah, I think I'd agree with you. We're very optimistic for the asset class as a whole. I think there have been developments within the industry in terms of types of fund structure, in terms of what's happening in the broader markets, just the growth of private markets overall, whether that's equity or debt. So the opportunities there, the accessibility is getting ever better for different types of investor. So we think it's a really interesting time to invest for, as you say, all types of investors at the moment.
Tell me a little bit about how HSBC Asset Management is set up. How do you prosecute the market and organise yourselves?
So we've been investing in alternatives for a long time, since the late 80s. So we've got a really long track record in the space. We have a team focusing on the private side, on private markets, with an average tenure of 20 years, so really well-experienced team. They're globally sat, so near where we invest, and we invest globally. We have experience investing in Asia, Europe, the US, and then we deliver those investments to our clients. And we have institutional clients, and we also have individual clients, predominantly in the high net worth space.
So, devil's advocate question, why would I invest in alternatives in the latter half of the 2020s? Haven't I missed the boat?
I don't think you've missed the boat at all. I mean, it has been since the GFC, which is obviously some time ago now. It's been a really interesting place to invest, and there's been some great outcomes for investors if you've done the work and you've done the research and you've invested into the right areas. But we think that it's a space which is continuing to grow. The number of listed companies is continuing to shrink, and the number of private companies is really growing. So the opportunity set is huge. So I don't think you've missed the boat at all. You do have to do your work, but that's the same as any type of investing. So if you can do the due diligence, if you can select the managers, partners to work with, there's some really exciting opportunities.
When I'm thinking about how can we explain the attractions of alternatives to investors, you made a case on both sides. One is that private markets are growing, but also that public markets aren't necessarily growing. And so it's almost like if you want to stay appropriately diversified and have a stake in the economic success of your economy, it's difficult actually to ignore private markets, isn't it?
I think it is getting harder to ignore them. I'd agree. I think they are becoming a more prevalent part of the overall investment sort of universe, whether it's on the equity side or the debt side, whether it's infrastructure, all areas. The private markets are growing and growing. And I think as an investor, really you want to be diversified. You want to have different sources of return coming into your portfolio. That's what makes a resilient portfolio. So ignoring a large part of the overall investment universe is most probably not the best thing to do. It's a really exciting thing, really interesting thing, and we think will enable you to build a better, more robust portfolio over time.
And increasingly that applies to all types of investors. Do you cater to all types of investors?
We do. So historically, private markets have really been the sort of realm of endowments and pension funds and things like that. So institutional investors. Developments in fund structures, really in regulation, as the market has grown, has enabled the market to open up and become more accessible to individuals. At the moment, really, it's sort of the high net worth segments that can access that. But there's the democratization of alternatives, which a lot of people talk about, which is happening. And we are, playing our part in that. We think it's a really interesting development. Needs to be, approached sensibly, but we think it's an exciting development for the industry and for investors to be able to access those markets, access those return drivers.
If you were an HNW, a high net worth individual, and you were considering a commitment to a private equity evergreen vehicle, what are the things that you would look out for? How would you assess the vehicle and the manager?
Yeah. So I look for a manager who's proven, who has had experience, whether it's not exactly that type of vehicle, because those types of vehicles are relatively new, but what have they done in their other types of vehicles? How good are they as an investor fundamentally? Hugely important. And then in terms of the actual fund structure, the types of assets that they're putting into that fund, and does it match? Is the duration correct? Are they going to be able to support the liquidity that the fund offers? And how that fund sits within their broader business. How committed are they to this type of business? And how do their allocation policies work? If they've got closed-ended funds and open-ended funds, is that fair? Is it equitable to all of the investors with that group?
Right. And what's the HSBC answer to that?
So the HSBC answer to that is yes, absolutely. So we have clear and defined allocation policies about how we will allocate different investments across different portfolios. So it is fair, it is equitable for our different client types. It's very clear, it's written, and it's followed.
Let's talk a little bit about the actual underlying sub-asset classes, let's say. So you look presumably at private equity, private credit, infrastructure. How are you differentiated in those areas? What do you like to look at?
So I think we have slightly different approaches to the different asset classes. Within private equity as a whole, we really are looking to partner with asset managers, whether that's the larger GPs in the sort of larger buyout sort of growth areas, or within mid-market, so smaller companies across the globe, and then geographically dispersed as well. So whether it's in Asia, whether it's in Europe or the US. So it's really trying to build long-term partnerships with managers that we consider to be sort of top quartile, top decile, who we think will continue to be able to be there to really deliver returns. So it's quite diversified by GP, by manager. The underlying portfolios of each of those managers is not necessarily hugely diversified, maybe 20, 30 companies. But when you build it into a portfolio, you get a quite diversified and resilient portfolio.
And you look at the largest right through to the mid-market and smaller?
Exactly.
Right.
So, yeah.
The thing that I find perhaps a little bit surprising about private equity, given that like the bulk of the market is still in the mid-market, it still seems to be an industry that's rather centric around global financial centers. So there's a lot of activity in New York and a lot in London and some in Singapore. And yet potential value creation is happening out there in the real economies and in smaller economies as well. So I'm going to go out on a lim and say perhaps you have a competitive advantage in accessing some of the more non-obvious, non-mega buyout, non-New York-based buyouts,
Yeah, no, I mean, we obviously, HSBC has a huge footprint globally, and we can leverage that. We can lean on that as part of our process. So that does give us an advantage in terms of sourcing, finding managers. Obviously, the group as a whole has many relationships, many touch points with companies of all different sizes across the globe. So when we're looking to find investments, obviously we can work with other parts of the group to help source those. So obviously, we do all our own due diligence and work to actually identify the investment and decide whether we want to do that. But yeah, in terms of access, I think we have a very sound footprint, a really good base to work from. And if you look across our portfolios, we are invested in the mega buyout, the really big groups. But we are also invested in a lot of smaller groups, and they're not all New York or London based. Some of them are in the sort of second tier cities, in whether it's in Europe or whether it's in the US or in Asia as well. And then even when working with some of the larger groups, when you look at where their investment professionals are based, a lot of what we're looking at when we're looking to select a GP is how do they source, how do they find the underlying investments. So if they're all just sat in New York or in London, maybe that's not as attractive. If they've got a broader network globally or in the region that they are focused on, then that's something obviously that we look to leverage.
What about some of the other sub-asset classes?
Sure. We have a slightly different approach with private credit. So with private credit, with credit investing as a whole, we want to be as diversified as we can at the individual credit point. Because the thing that can hurt you really is defaults. we accept that there will be some defaults. There'll be some individual defaults, if we're investing across thousands of credits, which we are, but we obviously want to minimize that. So if there is one, we don't want it to cause much pain.
So you don't think a concentrated strategy in private credit makes sense?
Correct.
Okay.
So we are relatively concentrated at the GP level. So you won't see as many GPs, but the underlying portfolios of each GP is much more diversified. So then if you look at the portfolio as a whole and you look through, it is a more diversified pool.
Right. Does that mean you have to invest with larger private credit managers in order to get a larger diversification?
We do. So again, we are invested with some of the larger groups, and we do move down into the mid-market, but even those are still investing across quite a broad number of companies. So we don't tend to invest with GPs who have very concentrated portfolios underneath. Okay. We're really seeking diversified portfolios at the GP level, which obviously we then build into a broader portfolio.
So diversification is the key criteria. Is there anything else?
Underwriting. So really, it's a risk management exercise. So it's underwriting the credits, and then it's being very, very diversified across those credits. So it's really looking at that track record of the GP, how they underwrite, what types of covenants they get with the companies that they're lending money to, how strict they are with those. So it's really understanding the whole credit investment process.
It's still a relatively new area, isn't it? Private credit. I had a private credit guest on as one of my first guests back in 2019, and I felt like I was going out on a limb a little bit back then, and now it's so mainstream. But it's all very new and evolving rapidly. I read recently that there's even private credit in the investment grade space emerging. Is that something that you're looking at?
We do look at it. It's not something that we've participated in at the moment. So everything that we're doing is really sort of sub-investment grade today. But it's an interesting space. As banks gradually sort of draw back, balance sheets are not being used as much. There is space for these other lenders to come in. So it's an area again that's growing. As you've seen, the equity markets change and shift over time. We're seeing this. We're seeing the same sorts of things happening on the credit side. So it's really exciting. I agree in terms of timing. So we started really looking at this in 2015.
Right.
So not very long ago, really, in terms of investing. And then we've built our business, over the last 10 years into something which is now quite sizable, and the performance has been really in line with what we've expected over time. So we're very pleased so far. And again, we expect that to grow and continue to grow as the market grows.
There's this strange, maybe it's not a strange phenomenon, but from an outsider's perspective, the fact that private credit funds compete with banks, and yet they're also a significant and growing client to the banks, is odd, let's say. But you are part of a bank and you've got a lot of banking heritage. Does that help? Does that heritage help in your prosecution of the private credit market at all? Or do you see yourselves as private markets players, really?
Within the area that I sit in, we see ourselves as private market players, really. Obviously, the bank is there and they have their activity, but we are segregated off from that. You'd expect us to be, and we are. Within HSBC Alternatives as a whole, we do have our own direct lending strategies where they do work alongside the bank, which is a really interesting strategy, but that's in a different area of asset management. So there are areas where we can work alongside the bank, or parts of asset management can, but from my seat, we're independent of that and we're really looking across the broader private market.
Right. So we've done private equity and private credit. Are there any other big buckets that it's worth mentioning?
I think those are the biggest. There's infrastructure, which is obviously a pretty interesting place to invest with all the development happening, whether it's in developing economies, in developed economies, whether it's Europe, US, Asia, etc. There's obviously a huge amount of money being spent on infrastructure, and a lot of that again is coming through private funds and private capital. So there's some really interesting things to do there, particularly on the transition side of things. And then there are sort of sub-asset classes, I'd say. So within private equity, there's venture capital, something which we think is really interesting, something which we've been investing in a more coordinated manner for the last 2 years or so. Right. And I think that's an exciting thing, again, to be able to bring to not only institutional, but some of the individual clients that we have through our wealth business.
So what's your angle there? What are your criteria? What attracts you to a VC manager?
So within the VC space, again, it's similar to our private equity, broader private equity program. So we're really looking to try and partner with the best managers who have really proven track records over multiple vintages and work with them and bring them to our clients. The disruption that we've seen broadly in markets over the last couple of years has meant that accessing those managers is something which we found a little bit easier over the last couple of years. So it's been a good time from an investment point of view to build those relationships, to start working with them and partner with those groups to bring them on. So we think it's a really attractive time. We think there's some really attractive investments to be made, valuations, etc. So we think it's a pretty interesting thing to be doing right now.
Wildcard question. But the reason I'm going to ask is that my guest, which we're going live with tomorrow, is a Bitcoin ETF provider.
Okay.
And I asked because, the reason I had him on was, I'm interested in Bitcoin, but it's like, I didn't have him on for ages because it's like, it's not really our market, but it is all an alternative.
Yeah.
And institutions are starting to get into it. And so Bitcoin is the ultimate alternative. Does it belong anywhere in the HSBC's alternatives business?
It doesn't today. It's not something that we're investing in. We look at it and we talk to managers and who are experts in the field, just as market color to try and understand exactly what's happening. But it's not part of our investment portfolios today.
But you are investigating it, clearly.
We'll continue. We'll look at all sorts of things.
You're open-minded.
Open-minded, and that's all sorts of left field things. Does it mean that we're going to invest? No. But you need to understand what's out there.
Sure. Let's go back to how you prosecute the market from an HSBC perspective. So what are your assets under management in the alternatives business division?
Sure. So HSBC Alternatives assets under management are around $75 billion today. So pretty sizable. I think it makes us a good sized player. We're big enough to make a difference. We're big enough to be important in the market, but we're also not so big that it makes it difficult to maneuver and difficult to execute. So I think it's a pretty nice size to be. Obviously, we're looking to grow that and build that over time, but we do it in what we think is a sensible and sort of relatively conservative approach.
Yeah, so it's a meaningful sum, but it's somewhat smaller than the very biggest alternative managers. So that enables you to be fleet of foot and a bit more nimble and look at non-obvious things.
Exactly. Yeah. And if we're working with a smaller manager, we can do that. We can work, we're important enough to those mega big buyout managers. So, we can access, we can, be an important partner with them, but we can also work with much, much smaller managers without, it causing a problem to them or us. So it enables us to be more diverse, more fleet of foot, as you say.
And there's space to grow without hitting any constraints. So what are your growth ambitions? Are you looking, for example, at any manager M&A?
We're looking to grow the business generally over time. So we'll work with our clients obviously to try and raise more money. We'll try and expand our client base. We'll try and penetrate into our client base more. And obviously we'll see where we go with that growth. But I think it's looking quite healthy today.
And in terms of how you work together as a team, so how many people sit in the alternatives business?
So alternatives business as a whole, we have several hundred people in there today. Within the area that I work in, where we're looking to allocate to private markets teams, we have about 100 people in that area.
What's the other part of the alternatives business then?
So the other parts are more the direct investing. So where we're doing the actual direct investing in private credit or infrastructure, etc. So where we're looking to partner with other managers.
I see.
It's around 100 people. And that's, those teams are placed across the globe. So we have people here in London, we have people on the continent in Europe, we have people in the US, we have people in Asia. So really where the investments are. So we'll put the investment teams there, and then we'll have more client-facing team members where our investors are, which is typically here in London, again in Europe, and then in Asia.
So my impression of large alternative asset managers is that they are relatively siloed within private markets in the different segments. Is that how you're structured, or is there some level of cross-collaboration?
There's cross-collaboration at the more junior levels of the organization. So as we move up through the organization, people tend to specialize more. They have their experience, et cetera. And obviously you want to leverage that and work to the advantage. So from an investment committee perspective, all of those teams are present, and there are people from infrastructure, credit, equity, et cetera, who are voting across all of the assets. So you can learn things from infrastructure, from credit, from equity, which applies to the others. So to silo them off and keep them completely independent, I think is wrong. But at the same time, there's a natural cadence to some of the work, and it's not necessarily the same across them all. So there is some siloing, but we want to try and keep cross-fertilization of ideas.
Yes,
we want to try and keep it interesting. And as I say, for the younger team members, we want to keep it interesting because you may think that you want to be a private equity specialist today, but then as you learn more and see more of other asset classes, you might want to move, and we want to support that.
I would imagine there's a bit of a battle for talent in the private market space. What's your sell for HSBC, and also what's your advice to a young professional that's interested in private markets?
Yeah, so there's definitely a bit of a battle for talent. So I think from an HSBC perspective, I think working at HSBC and sitting in the seats that we have, it's a really interesting place to be. I think it's a great culture to work in, and then you're obviously representing the group, going and the clients going out to the market to engage with industry experts across those different asset classes. Your access is unparalleled. I think it's a fantastic opportunity. Obviously, I've worked here for a long time. I feel like I've benefited from that and really enjoyed it over the years. I think, in terms of advice for people coming in, when I'm interviewing or talking to the younger people on our teams, it's really about rolling your sleeves up and being prepared to get involved in everything, all aspects of the business, as much as there are some areas which maybe seem to be a bit more glamorous or a bit more exciting to be involved in. Just knowing that one part is not that helpful to the organization. So, be open-minded, roll your sleeves up, get involved, take the initiative, do things. If you think that something can be done better, then think about it and come with a solution. Don't just, sit back and say, well, this is how it's working and, my boss is going to tell me. Like your boss can't know everything. So I think it's really about being proactive, rolling your sleeves up and being involved, being curious, being interested.
So what's an example of a non-glamorous thing where you can roll your sleeves up and get involved?
If you're thinking about, on the private market side, so data in private markets is difficult. It just is, right? It's not the same as public markets in terms of you can't just buy a wonderful data feed and it's there. It's much harder to get that data. So if we're thinking about aggregating the data and examining that, sometimes that's not the most exciting thing to do. You're sat there with your spreadsheets and this and that, trying to work out what you're doing. But if we get that right, or when we get that right, and when we can improve that and make that more efficient, that's huge for our teams because everybody needs that data. We're all trying to work out what we think the best investment is. So that's not necessarily something that someone just wants to do all the time, but is very valuable.
The data thing is also quite interesting from a client perspective, because client reporting is obviously important. And I guess the further down in terms of the size, so the democratization trend becomes the more, I guess, systematized you're going to want to be, I guess, as an asset manager with regards to reporting. Do you have a digital platform, or how does that work?
Yeah, so you're right, and as an industry as a whole, I think it's got a lot better. We participate in that, so we do use some digital platform services. We're always looking at our operational infrastructure, trying to see what we can do to make that better, more robust, be able to deliver the reporting, etc., to clients. So there's a lot of investment in that side of the business for ourselves, and in the industry as a whole. It's changed hugely, I'd say, over the last 4 or 5 years, really.
So in the last 4 to 5 years, it's become easier. And that must have an impact on your operating costs and therefore eventually, presumably, on fees.
Yeah, so it will have an impact on the operating costs. It will have an impact on fees over time. But also, I think more importantly, it enables you to then push out into those other markets. So that whole democratization point, one of the hurdles to investing is the operational complexity. And if you can remove that operational complexity, then you can open out to other types of investors who can't necessarily cope with that operational complexity. They don't have, an operations team working for them. They are an individual who are working with their advisor. So I think that's the much more important aspect.
But on the flip side, so just to contradict myself, if you're taking the complexity away from the investor, it means that to some degree you are taking on complexity. for example, and to ensure that they stay fully committed or that kind of thing. And so
Yes.
maybe the fees don't go down.
Yeah, so I think if you I mean, really to get them in, to get investors fully invested, etc., it's these evergreen funds. That's the big change, right? And then if you look at the fees within those, it hasn't changed massively really from the closed-ended. There's a different type of fee and things and how they work, because you don't have that drawdown structure anymore. You're 100% invested from day one, and then obviously you can redeem over time if you so choose. From a fee perspective, today hasn't changed hugely. There are some funds where you're beginning to see a little bit of fee compression, and I think you most probably will over time in the industry see some as the industry grows and becomes bigger and a more mainstream part of a person's portfolio or an investor's portfolio. I expect you'll see that.
So, of everything that you're investing in at the moment, what personally really excites you and turns you on when you get the meeting coming up and you think, oh, good?
So mostly sounds a bit cliche, but I do find pretty much all of it quite interesting, really. I mean, I think it goes back to the comment about sitting in a seat like we have at HSBC. It's a fantastic seat to be in. So whether it's going and meeting, a large, huge buyout manager who you may think, oh, I've heard this 17 times before. You haven't. There's always something new. There's something interesting that they are working on or thinking about, or situations which they're working through, which are really interesting. Likewise, if you're talking to the smaller, the lower end of the mid-market, where it's much more, nitty-gritty mums and pops businesses and the challenges that they're having, whether it's business specific or broader economy or whatever it may be, it's really interesting. So it's that breadth of information and access, to me, is the really exciting thing. It's not like an individual, let's invest in this one thing today.
Yeah.
We don't really approach it that way. We are always trying to build a relatively diversified portfolio. We do make some tilts, but it's always got to be pretty diversified, pretty robust, because they are multi-year investments. And as much as you think today, that's the thing, it may not be in 3 years or 5 years.
Yeah.
So it's diversification.
To what degree do you make a commitment and stick with it? And to what degree are you strategic and looking at your strategic options with regards to fund investments?
Well, we're always trying to be a long-term partner, a long-term investor. So we try and think through, do the work, make that investment and stick with it. Within the private side, making more tactical adjustments and things like that is quite difficult. We do have the sort of hedge fund side of the business as well. So it's a bit more tactical in what you can do. Obviously, those investments are a bit more liquid. So when we're thinking about that side, we'll move around a bit more. But on the private side, it's much more strategic, long-term. Let's think about where we think opportunities are in different industries, different territories, different geographies, and gradually build the portfolios and tilt them. But you've got to remain diversified within that, because you don't know.
It really is an oil tanker type business, isn't it?
Yeah.
Yeah. Now, what do you think's in store over the next 5 years? What kind of growth could we be looking at? And are there any particular areas that you think look like they're ripe for growth?
I think we just see continued growth across those different markets, really. I think that the trends that we have in place in terms of the growing of the sort of private market universe, whether it's on the equity side, credit side, I think that just continues. As the sort of democratization happens more as well, more capital comes in. I think that it just continues to grow hopefully at a reasonable pace. Obviously, it has grown pretty quickly over the last 10, 15 years. I don't think it continues necessarily at that pace, but I think it continues to grow at a healthy rate. And I think that the opportunities for individuals, for institutions are there, and I think they're really exciting.
What do you think the gating factors are? So you think it'll keep growing well, but maybe not as quickly as before? Why not?
I think it's developed a lot. It's matured a lot. It's got a lot larger already.
Right.
So you just aren't going to see. Or I don't think you'll see sort of exponential growth from this level. But it will continue to grow. The actual growth rate we shall see. But I think that the opportunities the investment opportunities are there. I think they're pretty exciting, and I don't think we have any real issue in terms of, continuing to find those. It's not saturated by any means.
Right. Great. Well, William, thank you very much for sparing your thoughts for Fund Shack. It's very interesting.
Thank you. Thanks for having me.
You've been listening to the Fund Shack podcast. Wherever you're listening or watching, please click follow or subscribe. That's all I ask. Thanks for listening.